It's hard to get away from pensions because we have pensions in our jobs, or we don't have them, and therefore we have to fund them. And many of us, of course, are of that age where we get the old age pension. So all of us at some point in our lives have to think about pensions. I'm joined in the studio now by Chief Executive at IFG Ireland, Pensions, Investments and Advisory Services, Gary Owens. Gary, welcome to the programme.
Thank you, George.
Now, it is a big story, and it remains a big story. A headline in the paper says we need a minister for pensions. Another headline in the Sunday paper says they may cut the old age pension by €10. Is there kind of benchmark in all this discussion, is there?
Well, I think a good place to start, George, is the OECD report, which was published in April only of this year, which was really recommending a series of key changes. The four kind of key recommendations that came out of that was, one, a change to the state pension, either to the basic or introduce means testing. The second was to accelerate the public sector pensions, so move them more aligned with private sector pensions. In other words, that the individuals start to fund for themselves and accelerate that. The third was to introduce mandatory pensions. Effectively, everybody had to contribute to provide for themselves in the future. And the fourth was to introduce some legislation on defined benefit schemes, so you could actually protect employees. The pensions the numbers are frightening. I mean, it is a big and serious issue. When you look at the state pension, the OECD are suggesting that there'll be a $5 billion deficit within 5 years. If you look at the public sector pension, there's 116 billion of a deficit. So if we were to close it today, the taxpayer and the government would have to actually fund 116 billion to pay for the existing public sector pension.
All right, let's take two of those because they're frightening numbers. 5 billion within 5 years. In relation to the old age pension, 116 billion in relation to public service pensions. Now, taking the second one first, of course, the problem with the public service pension is that it's not provided for in the way that any other pension is, where you invest money and it gains interest and it pays out a pension. It's taken out of day-to-day income by the country, so that the more public servants we have, and this is to bash, but the more we have, then the more money this famous 116 billion kicks in. Yeah,
will continue to grow. I mean, I think the recommendation is that you change that commitment and move the promise away from the government and taxpayer funding it to them providing it themselves. And that changes what's happened in the private sectors. If you go back sort of 5 or 6 years ago, we've had a fundamental change. It's a real paradigm shift where the government or employers were seen to be responsible for largely funding our pension schemes. And now what's happened is individuals have to take responsibility themselves.
Yeah, but that's all very well. But defined benefit. Now, the point about defined benefit means it doesn't matter how much you paid in or how much money is in the pension scheme, you're going to get a defined pension, say half your closing salary, for instance. Now, in the case of Waterford Glass just recently, where the pension fund didn't have enough money to pay, the EU stepped in and said, no, the government has to pick up the tab. No, now if that's repeated across the board with all these pensions that have lost money,
yeah, and that was the third frightening number I was going to give you, which is the scheme deficits is 15 billion. It's in excess of 15 billion. So in theory, if all defined benefit schemes could not fund the promises, the government would have to step in if the Waterford Glass case is seen through, and effectively, the taxpayer would have to fund that as well. So the issues are, I mean, pensions are complex. They're very complex, and it does need focus, and we would strongly welcome the appointment of a pensions minister. There's a whole range of things which come out of the report which have to be actually dealt with.
And you think that because we don't have a specific minister for pensions, whichever minister whose remit it is, he has too much on his plate to be worrying about this, is it?
Yes, and I think it's also conflicted in terms of your portfolio that you would look after. But when you look at the size of the problem, and you look at what you take the 4 recommendations. If you take the first recommendation, you're going to have the grey vote, who will resist any change to basic pensions, and rightly so, because effectively, and we would be strongly of the view that you shouldn't have any retrospective legislation. People should be able to plan for changes well in advance of them actually occurring. If you take the second one, the public sector changes, they're also a big vote. If you take the third sector in terms of mandatory pensions, it means that employers are going to have to contribute to fund where the 50% of people have no coverage. So you again have a big population. So it will take a brave government to actually take the 4 key recommendations and actually implement them. So I think that if you had a pensions minister, they can take control of the strategy and start to, one, deal with those issues, and then secondly, one that I feel quite strongly about is there's 72 billion of assets in corporate pension schemes in Ireland, and there's more in individual pension schemes. Those pension schemes, contributions do get a tax relief benefit on it, and there's a lot we can do with that in terms of the economic growth strategy. So we can insist on a proportion of those assets going in to growth strategies, infrastructure, whether it's water, energy, road infrastructure, create jobs.
Right. Now my guest is Gary Owens of IFG. They're the investment consultant, so every day he works and worries about pensions. But the thing about telling people, for instance, you go to the public service, you say, look, you don't have a pension with the government anymore, you have to fund your own pension. Now, what we've seen in recent times in the private sector is companies in trouble say to an employee who may be 50, you expected a pension of 50% of your closing salary? Sorry, it's going to be 30%. Now, at 50, there is no way that person individually can make up the shortfall, isn't that so?
Well, it's more difficult, George, because they've got a lot of. If you look at the stats, there's no doubt that any sort of significant changes have got to give people the time.
But the time is like 40 years.
Well, you're not going to get that time. The reality of the numbers that we're actually looking at is they are frightening, and we cannot afford them. And no matter what way we look at it, we cannot afford them.
When you talk numbers, once you get over 1 billion, it becomes meaningless, because none of us have ever seen 1 billion, so we're not sure what it looks like. What, sadly, is the downside of these numbers if not tackled?
Well, the best example of that is in defined benefit schemes. So what's happened in defined benefit schemes is employees who were guaranteed a promise are actually not going to get it. In many cases, water for glasses is the best example. And you can use, the public sector is in exactly the same position. If we cannot afford to pay pensions for the public sector employees in the future, they will end up getting reduced. And that's why you're better off dealing with the problem now, well in advance. And we have enough information from all around the globe and with defined benefit schemes to know exactly what happens when the costs get too high.
But the costs get too high for 2 reasons. One, obviously, investment. You haven't been able, when somebody gives you money to invest on their behalf, you haven't been able to make as much as you did in the past because interest rates are lower and so on. But secondly, the prospect of these people in their 60s, they have a prospect of living for 25 years rather than a previous generation had a prospect of living 10. So now they've got to pay for a pension for 20 rather than 10 years.
And there's 2 big reasons why. One is people are living a lot longer. That's the biggest issue.
Yeah.
So the state or an employer is guaranteeing and underwriting the fact that they're going to have to pay a pension for life. And those years are just extending and extending. And the second is when you're in a low sort of return environment, you're not getting the types of returns that you need and that you were assuming in the past. And both of those combined together have meant there's significant deficits in both the public sector and indeed in the private sector.
Now, as I suspected, people are texting me and said, look, I have to buy the meat, I have to, buy clothes, I have to all this, I can't put money away for a pension. Explain the advantage of putting a relatively small amount, but putting it away at 25 as opposed to starting a pension contribution of 50?
Oh, it's significant, George. I mean, the earlier you start, I mean, mandatory pensions, the UK is probably a good example. They've introduced auto-enrolment where people have the option to they can opt out within 3-year periods. But mandatory pensions effectively means you start at 3%. It can go up. In Australia now, they're up to 9%.
9% mandatory?
Yeah, and then that's progressive over time as people get used to, the fact that they have to save. Pensions are expensive. So the earlier you start, there's 3 simple sort of rules. One is how much you put in and for how long. The second is where do you invest the money and make sure you're well diversified in terms of your portfolio. And the third is how much is it costing you? What are the charges that are being incurred by your pension advisor or your administrator?
But you at IFG, presumably you have to tell me what charges you're putting on any money I give you to invest in my pension scheme. Is that right?
Well, there's what we call transparent charges, where we do tell you what we're charging for advice, and then you've got the trading expenses within the fund. So you just need to be careful that you fully understand that.
But we're also seeing massive change, surely. Somebody like you at IFG investing my money, traditionally you might have put it in bank shares, you might have put it in property companies, you might even just have put it on deposit because there was a reasonably good interest rate. Now, those 3 traditional areas of safe investment, as they would have been seen, are now gone. Isn't that so?
Well, I think that, it depends how you define safe, George. Diversification across assets and different global territories is much safer. When you look at what happened in Ireland, we had accumulation risk, so a lot of people invested in bank shares and in property. And when property actually collapsed, the bank shares effectively dropped as well. So, and most of it was in Ireland. So, a good pension advisor will have you well diversified across the globe with good fund managers, and will also de-risk you as you approach retirement. So you're not actually exposed to it in the last 10 years of your life.
But dare I say, the theory of diversification has been around for a long time, and yet we have seen, particularly this last decade or so, we have seen, and when there were creditors' meetings at banks, we saw people there tragically having lost maybe everything. Why do people not understand that basic fundamental point about saving, diversification? Is that your fault at companies like IFG for not shouting it louder, or is it just natural sort of greed that says I'll put it in a thing with the best return?
I think there's 2 points really. Most people saw banks as being the most secure, and for years it delivered, and people lived off the dividends of bank shares. So it's hard in hindsight to say you should never have actually invested in bank shares, but the golden rule is real diversification across geographic territories and asset classes. And a good advisor who's using good tools will make sure that you are. And as you're approaching retirement, you've got to take risk off the table. You've got to de-risk it so that in the event of, if you take the equity markets, they're now back ahead of where they were when they collapsed in 2007, 2008. So it's made up the 40% drop. But if you're retiring, you can't actually afford that to 40%. So you have to de-risk it.
Okay. Lots of people, as you can imagine, talking about ministers and TDs who don't pay for their own pension. But of course, by and large, apart from the various additions, public service pensions, and for lots of major companies, pensions were seen as non-contributory in many cases. Again, people are asking about ministers. They could take them early, but now they can't. The older ones can, but newer ones can't. So we are seeing some move in the kind of direction you're looking for.
Well, I think,
every public servant now has a pension levy.
They do, and all the OECD is saying is you should accelerate it and not, it's moving the guarantee from the employer or the government to the individuals. And the reason for that is the employer can't actually afford to guarantee longevity and asset returns. They just can't afford it, and they set out with a cost of between 10 and 15% generally. They're now looking at 50 and 60%, so they just can't afford it.
Finally, if we stay with an old age pension, and I think we should.
Yes.
aren't we have to look at a point where if somebody is now living to 85, where previous generations lived to 70 years, so they had 5 years of a pension, now we're looking at somebody at 20 or more years of a pension, aren't we essentially going to have to say you're not going to receive your pension until a later age because you're going to be living for much longer?
Well, one of the interesting things out of the OECD, because we have already increased the state pension age, it's going to 66 in 2014 and up to 68 in 2028. That actually is higher than other countries. So I think what will happen is people will end up working a little bit longer. But I think the OECD report is quite strong in terms of changing the state pension over time. And I think with anybody, you cannot afford to say to people who are going to retire within sort of 5 years that your state pension isn't going to apply in the way. And in many cases, you would have contributed through the social insurance fund that you're paying.
All right, thanks so much for joining me. Gary Owens, that's not high kicks up in the air with a rugby ball. That's what my guest is named, Gary Owens, Chief Executive with the IFG Ireland, the Pensions Investment and Advisory Services. So look at your pension. Chris says, why does it have to be invested? Why can't it just be saved? Saving it is a form of investment. That's what deposit interest is, Chris. It just may not be enough. $1 million at the moment will probably get you a pension of about 20,000. So try living on 20,000. My thanks to my guest. In a minute,